Welcome back. So glad you're here. Today on The Explainer, we're doing what we do best, taking a massive pile of raw data and turning it into something you can actually use. We're running a full financial diagnostic on Peabody Energy, ticker symbol BTU. We're going to look under the hood, cut through the noise, and just see what the numbers are telling us. Buckle up, because this one is a truly fascinating case study in mixed signals.
Okay, I want to hook you right away with this absolutely staggering number, 272.19%. That is BTU's 5-year return. If you held this stock over that exact half-decade, you're looking at a huge, portfolio-defining win. I mean, it's the kind of number that literally makes you want to smash the buy button without a second thought, right? But then, bam, we hit a brick wall. Negative 19.62%. So let's dive into this. How does a stock that's up that much over the long term just suddenly drop nearly 20% this year? It's a crazy juxtaposition. Massive historical gains crashing right into this painful, sudden decline. And that is exactly why we're doing this diagnostic today. We got to figure out which one of these numbers is the real Peabody Energy. So here's our roadmap to solve the puzzle. 1. Vital signs. 2. Valuing BTU. 3. The internal engine. 4. Historical returns. And 5. Our summary diagnosis. Let's get into it.
Chapter 1. Vital Signs. Let's check out the surface-level market data.
Let's anchor ourselves right here. $2.901 billion. That's Peabody Energy's current market cap. So we're not talking about some tiny speculative microcap play here. This is a massive multi-billion-dollar operation. And when a beast this size swings as wildly as it has, you know some huge macroeconomic forces are at play.
And speaking of wild swings, just think about this volatility over the last year. The stock peaked at a 52-week high of $41.14, but it also bottomed out all the way down at $12.58. Right now, it's sitting dead in the middle at $23.82. Put that into perspective. It's down over 40% from the peak, but up almost 90% from the bottom. That is a terrifying roller coaster to be on, and it pretty much screams that the broader market has absolutely no clue how to price this thing. Chapter 2. Valuing BTU. Let's see if the price is right. Look at the tension we've got going on right here. The current price is sitting at $23.82, but the discounted cash flow model is pointing to a fair value of $28.14. That gives us a really solid 15.35% margin of safety. So strictly on paper, this stock looks like it's on clearance.
And check out these multiples. The price-to-book ratio is under 1, 0.83 to be exact, which means you're theoretically paying less than the liquidation value of their stuff. The PEG ratio, which measures price relative to growth, is an insanely low 0.17. These numbers absolutely scream deep value. But then there's the PE ratio. It's negative 24.06. And guys, that's a massive glaring warning sign. You literally can't have a negative PE unless the company is actively losing money.
So this stops us right in our tracks and forces us to ask the million-dollar question. Is the underlying business actually profitable? Because honestly, it doesn't matter how cheap a stock looks compared to its book value if the core business is just incinerating cash instead of making it.
Chapter 3. The internal engine. Let's look at performance and cash flow.
Okay, here is the grim reality behind that negative PE. Over the last 12 months, Peabody Energy posted a net income loss of almost $120 million. And it gets worse. Their free cash flow over that same stretch, negative $182.6 million. So this isn't just some clever accounting loss. Actual, real cash is pouring out of the business right now.
These metrics show us exactly where the pain is coming from. It's a severe margin contraction. Just look at the gross profit margin. Over the last 3 years, they've averaged a really healthy 24%. But right now, that's totally collapsed down to under 15%. Because they're making less at the gross level, their free cash flow yield has just fallen off a cliff, from a fantastic historical average of over 12% all the way down to a negative 6.29%. The internal engine is severely sputtering.
And naturally, that translates straight into some really tough return metrics. Return on invested capital, return on assets, return on equity. These are the key vital signs for how well management is using their cash. And they are all flashing red right now, sitting around -2 to -3.5%. Bottom line, the investments management is making right now are actively losing value.
But wait, let's take a quick breath here. We actually have a very surprising and honestly much-needed bright spot. Their debt-to-equity ratio is insanely low at 0.10. So what's the takeaway here? Well, despite the brutal cash burn and the unprofitability we just looked at, they are not drowning in debt. They have practically zero leverage compared to their equity. That means they actually have the breathing room to weather this storm without creditors knocking on their door tomorrow morning.
Chapter 4. Historical Returns. The Long-Term Prognosis.
Check out the true nature of this beast. In 2020, you lost 73% of your money. Just a devastating wipeout. But if you held on, 2021 hands you a monumental 317% gain. Then 2022 gives you another 162%. And now year-to-date, we're back to a near 20% drop. This is not some slow, steady compounder, guys. It is a highly cyclical commodity stock, and it's swinging wildly based on external market cycles.
And this perfectly sums up that cyclical reality. Remember how we started this explainer by marveling at that 5-year growth rate of almost 30%? Well, that captures those massive boom years we just saw. But watch what happens when we zoom out to a 10-year period. The compound annual growth rate flattens all the way out to just 1.06%. So over a decade, those massive booms and devastating busts pretty much cancel each other out, leaving a buy-and-hold investor with almost zero real return.
Chapter 5. Summary Diagnosis. Time to weigh the evidence.
Let's kick off with the bull case. If you're an optimist, you've got plenty of ammo here. You've got a 15% margin of safety on cash flow and over a 40% margin of safety based on earnings per share. That ultra-low debt-to-equity ratio of 0.10 means they're built like a tank financially. Plus, a price to book under 1 suggests you're getting a huge discount on the underlying assets. Strictly on paper, the value metrics are incredibly tempting.
But you've got to weigh those bullish valuation models against some pretty harsh operating realities. The internal engine is seriously struggling. We're looking at a trailing net income loss of nearly $120 million, and they're burning through over $182 million in free cash flow. Capital returns are in the red, and gross margins are shrinking fast. You're basically buying into a business that is currently bleeding cash.
So that leaves us with a real financial paradox, and a huge question for you to ponder. Does a cheap, discounted valuation actually justify buying a business with negative cash flow and shrinking margins? Is Peabody Energy a brilliant cyclical value play just biding its time for the next commodity boom? Or is it a classic value trap hiding behind a fortress balance sheet? I highly encourage you to use the data we unpacked today to dig deeper and decide for yourself. Thanks so much for joining me on this explainer, and keep learning.